Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It doesn't matter if you're an investor, a homeowner, or a retiree with savings in the bank, the big story in the past week has been interest rates. The Reserve Bank increased the official cash rate by 25 basis points here in Australia. In the US, the Federal Reserve increased rates by 50 basis points. Meanwhile, the Bank of England warned that the economic outlook was deteriorating. It all comes back to inflation. But how far will central banks need to go? And what does it all mean for investors? Scott Haslem is the Chief Investment Officer at Crestone Wealth Management. Scott, welcome back to Fear and Greed.
Thanks, Sean.
What is going on, Scott? What is going on? What a week.
It has been reasonably brutal, I would say, in markets. And as you said in your introduction, rising interest rates, but I would say more so fear of inflation and the fact that central banks have just left it too late is really what's making markets very nervous at this point in time.
Something over the past week which has really come to the fore, and something that economists like you talk about all the time, but the rest of us probably don't think enough about, is, you said fear of inflation, it's expectations. So it's actually what people think are going to happen or expect central banks to do, as opposed to the day they do it almost.
Yeah, so there's a couple of things there that are pretty interesting to touch on. First one is, if we cast our minds back to the last 5 or 10 years prior to the past 12 months, we've been in a world where central banks have struggled to get inflation higher. And in that environment, they underachieved their inflation targets, keeping it with inflation too low, and that's part of the reason interest rates were very low. So when we started going through the recovery, central banks have sort of threw out of the window what they've been doing for the last 20 or 30 years, which is what we call preemptive or forward-looking inflation, and basically said they were going to be reactive and not move rates until inflation was in or above their target. You remember Phil Lowe from Australia's RBA telling us they weren't moving interest rates till April 2024. Well, it's May 2022 and they've already gone up. So I think the fact that central banks have moved away from forward-looking policy and had very reactive policy, we've been caught here with more inflation than expected, and now central banks probably are trying to catch up from a position. I mean, we are arguably living through one of the worst central bank inflation forecasting errors in modern monetary history.
Ouch. Look, let's start with the local economy. The aforementioned Phil Lowe had talked a lot about transitory inflation. What happened to that argument? We know that they're lifting interest rates to keep a lid on inflation. Is it not quite as transitory as we thought?
Well, I think that's right. I think it isn't quite as transitory as we thought, but I would say two things. Firstly, part of that lack of transitory nature of inflation is because we've probably taken too long to get interest rates up. But the second point I would make is I would still argue there's a fair amount of transitory inflation in there. We've just stopped talking about it, and we've just lost faith that what we've seen over the last 12 months in terms of the impact of the pandemic on supply chains, the developments in Russia, Ukraine, that these things are having temporary impacts on inflation. I think they are still having significant temporary impacts on inflation, and I think inflation will come down over the next 12 months. I think the question will be, where does it settle?
Okay, so the question for most of us, and most of us with mortgages, is how far interest rates will rise. So starting with Australia, how far do you think they'll go?
Well, it depends who you ask, Sean.
Yes.
If you ask the futures market, the answer is 4%, which seems extraordinarily high.
Yeah.
If you ask economists, the answer is 2%, and that seems to me to be a little bit more reasonable. But that's predicated on a view that at least some of the inflation we're seeing and may see over coming months will reverse course when some of the pressures that have driven it there also start to reverse. So I think interest rates are probably going to go up a few more times in the next few months. You would expect the RBA to move again 25 basis points in June. They will possibly go again in July. I think what we're likely to see is the cash rate, which was 0.1 a week or so ago, get up to a sort of 1.25, 1.3, 1.4 by the end of this year or early next year. And then it'll probably go up a bit more next year at a slower rate. But I think estimates that are around somewhere between 175 to 2 would be a reasonable place to think interest rates are going. But obviously, the different people have different views, and the market is saying it's going to go a lot higher. What we need to get is a little bit of comfort that inflation's going to start slowing at some point.
Stay with me, Scott. We'll be back in a minute. My guest this morning is Scott Haslem, Chief Investment Officer at Crestone Wealth Management. Okay, so part of the reason the Reserve Bank's doing this is that we had the pandemic and interest rates fell to abnormally low levels, so they're getting them back to more normal levels. Part of the reason is because the economy is actually doing okay. We are growing. The question I have, can the Reserve Bank do this without culling growth too much?
Well, history is not on our side, Sean, in terms of central banks' ability globally and in Australia to thread the needle, as they say, in terms of slowing growth enough to pull inflation back and therefore not drive the economy into recession. I think the odds are higher this time that they will be able to do this. And I think when we look at what I still believe to be a significant amount of transitory inflation, so if we take inflation in the US at 8%, I think at least half of that is transitory. In Australia's case, inflation at 5%, some of that, maybe a bit less, a couple of percent of that's probably transitory as well. So I think that's an environment where if we get that easing back in inflation, central bank fear and the amount central banks have to do could also come back a little bit, and that could increase the likelihood that we can not have to tighten interest rates so much to drive the economy into recession.
Okay, just looking globally now, in the US we have rising interest rates and a share market that goes up and down by 3 or 4% in a session, and quite incredible. We have last week we had the Bank of England warning about the outlook, worried about energy prices particularly. We have China and lots of economists saying, well, they're not going to reach their 5.5% growth rate because of their zero COVID policy or zero tolerance COVID policy. And Australia obviously relies a lot on China because we sell a lot of stuff to China. Looking outside our borders, it just doesn't look that good at the moment, Scott.
No, it is a very difficult global environment. It's a difficult investing environment. And I think in contrast to the 2020 pandemic, where, it's easy to look back and say that was manageable, but it was to some extent a pandemic, a health issue that caused economies to shut down, and we knew that if we could find a vaccine, they would open up again. I think at the moment, the position of the world is a little bit more problematic. We are asking some big questions. Are we at the end of 30 years of hyperglobalization and falling interest rates and inflation? I think we've spent 80 years since the end of the Second World War in a reasonably calm geopolitical environment. So I think there are some big questions that are really impacting the outlook. But I think if you put it together like that, it does sound pretty ordinary. But I think on the same hand, if we got some resolution in the Russia-Ukraine situation, that it could at least level out and see some retracement in the price of energy, and we started to see inflation pressures and supply chains and ports ease up a little bit, allowing inflation to come down and central banks not to have to increase interest rates as far as people are anticipating, I think we can still find a central case here where growth is okay, but not as high as we thought it would be. Inflation is lower, but higher than we thought it would be, and that we can still see sort of moderate returns in markets through the second half of the year. I think it's a reasonable outcome, but we are probably 1 or 2 months away from being confident that our view that inflation will start to moderate over the coming months is the right view.
Okay, so as an investor, how should I be thinking about this? If I have $1 million in my back pocket and I'm wondering how to invest that, where do I start given this economic backdrop?
Well, I think if you are an investor who is already in the market, then I think we would be focusing very much on reducing risk, making sure that our portfolios are diversified. And this is the key, is when you put a portfolio together, you need to have a globally diversified investment portfolio across a whole range of different asset classes, from fixed income, both globally and domestically, share market, both globally and domestically, as well as what we would call alternative investments, being things like hedge funds, private equity, which would include late stage venture capital and growth equity, and also real assets like property, toll roads, renewables. I mean, these are some fantastic assets that have inflation protection built in because they've got CPI impacted revenues. So I think you have to have a diversified portfolio because we simply can't predict the outlook. And arguably no one's ever been able to predict the outlook. So no single asset always outperforms. You need to have a mix of assets in your portfolio, and you need to make sure that you're diversified. So, you look at fixed income today, I can, Scott Morrison will take my money from me at 3.5% capital guaranteed. A 10-year bond yield now is a competitive investment relative to the dividend yield in equity markets. And this is what investors are battling with at the moment. But I think if you've got money to invest, you want to invest in a diversified way. You want to have a mix of assets. And I think we should also recognise that whilst I wouldn't necessarily be putting all of my money to work today, markets are 10 to 20% and some stocks are 30 to 40% below where they were 2 months ago. So it's not a disastrous investment environment. It's just a volatile one.
As always, there are opportunities, and just a reminder to the listener, this isn't an investment advice show. You should always speak to a professional advisor before making investment decisions. Scott, thank you very much for that little tour through the economy. It's kind of scary, but it's fascinating to watch as well.
Yes, well, as I said at the beginning, Sean, it's been brutal, but it's certainly extremely interesting, and we're living through one of the most interesting periods in human history. It's been a pleasure to be with you.
Yeah, I have to laugh a little bit. You and I have known each other for a long, long time. For you to say something is brutal, because you are a fairly measured character, brutal really means something coming out of your mouth.
Well, it's how I feel, and as you said, markets are going up 3% and down 3% day to day. That's a fairly challenging investment environment.
Thanks for talking to Fear and Greed, Scott. That was Scott Haslem, Chief Investment Officer at Crestone Wealth Management. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.